All right, here we go. What's up, my fellow wealth creators? Matty Ice here. So today, we're going to have some fun reacting to a YouTube video that I found and watched yesterday. Pretty much bashing infinite banking, talking about how terrible it is and you should buy term and invest the difference. And, here's the thing. I don't have a problem with people playing devil's advocate against these types of things and cautioning people about certain strategies and products. I think that's good. I think you need to hear both sides of the story before committing to something like this and making a major long-term financial decision. I don't have a problem with that. What I have a problem with is the misleading nature of that information, of this type of content we're going to go through, because it's literally titled "Everything You Need to Know About Infinite Banking," but she says nothing about infinite banking. She just basically bashes the product the entire time, there's a difference, guys. Infinite banking is a strategy. It's a process. It's a way of using a specific type of product. Cash value, high cash value, custom design, dividend paying whole life insurance with a mutually owned life insurance company. Not your traditional whole life policy that you can buy off the shelf or from your local State Farm agent. We're not talking about that. That's not what you use for infinite banking. But here's the thing. She didn't even bash whole life. She's bashing universal life products the entire time, which I actually agree with. I'm not a fan of any type of universal life product. They don't live up to the hype, man. It's just far more risk than reward, than the reward that you're getting or shooting for anyways. A lot of times you don't even get the reward that you're looking for. And so there we'll actually agree. I actually agree with her on a few things, but like just the misleading nature of this content, guys, I think it just doesn't serve people. And I want you guys to have all the information and facts about how these things work so that you can make the best decision for you. And, another thing I agree with her on is that infinite banking is definitely not for a lot of people. I think most people should at least explore it because just based on my own personal experience, guys, it is a really powerful financial strategy when you know what you're doing. But I agree that it's probably not for a lot of people because it takes a lot of discipline. It requires you to take responsibility for your personal finances instead of burying your head in the sand. Let's just max out a 401k and hope everything works out in 30 years. Nothing necessarily wrong with that, I guess. As long as you know and accept what the consequences could be later on down the road, just like I know and accept the consequences of doing infinite banking. And when I borrow against my policy and lend it on real estate, there's a possibility that deal doesn't work out. And I'm in a pretty tough predicament. But I also like to think I know what I'm doing anyways. And I mitigate my risk very significantly by knowing, liking, and understanding where I'm putting my money. And, being in a first lien position and stuff like that. So if the deal did go south, I could recoup my money. You see what I'm saying? Like I've taken the time to do the research, get the knowledge and education. Like I'm constantly educating myself. And so when something like infinite banking comes along, I'm like, wow, this is like a no-brainer for somebody like me. This tends to make sense a lot for like entrepreneurs, real estate investors, et cetera. But, you don't have to be any of those things to benefit from infinite banking. But you do need to, what you're going to find is that you're going to challenge traditional financial principles that have just been kind of shoved down our throat the entire time. This idea that you're going to be self-insured when you're 65, 70 years old. It's a completely separate video, but I'm just not a huge fan of that methodology or ideology at all. I think it's very risky. And having something like a permanent whole life insurance policy that, mind you, you can pay up. You don't have to pay into your entire life, which is how I know she's not talking about whole life in this video, because the story that she talks about, she talks about how the premiums increased, got more expensive over time. That's a universal life product, guys. It's not whole life. So my problem with these types of videos is she doesn't really say anything about infinite banking. She doesn't say anything about whole life insurance. It's just about universal life. Yet the video's titled "Everything You Need to Know About Infinite Banking." Watch this before it's too late, as if you're just going to get completely wrecked by it. But she's talking about something completely different. The problem is people are going to associate what she's saying with infinite banking, even though it has nothing to do with infinite banking. And then, a lot of people might watch it and be like, okay, infinite banking is a scam. I need to avoid that, and not even actually research it. And that just puts, it doesn't allow people to make truly informed financial decisions, because like I said, infinite banking is definitely not for everybody. But if you know how it works and you're able to consistently save money and you want a more efficient place to put your money, dividend paying whole life, that's the product. And then use that product to implement something like infinite banking strategy, then it can be really powerful, guys. I know this because I implement it and it's freaking amazing. And my policies are kicking rear ends. So anyways, it's my the intro rant, whatever you want to call it. Let's go ahead and play the video. I'm going to speed it up a little bit, just in the interest of time, and I'll pause it as we go and address what she's saying.
This is the worst financial advice that I have ever heard. It's that you should be your own bank by purchasing permanent life insurance, also known, thanks to the online universe, as infinite banking. So let me tell you a little backstory first. My parents purchased policies like these, and guys, they are not new. They are new marketing slogans.
So I want to be clear here. This is just kind of like a minor side note. There's no such thing as an infinite banking policy. I've actually used that term before just because it's easier, because I set my policies up specifically for infinite banking. But you're not going to call up a life insurance company and say, hey, I want one of those infinite banking policies. They're going to be like, what are you talking about? It just doesn't exist. You use dividend paying whole life insurance in order to implement something like infinite banking. That's the difference between the process and the product. All right, I just want to make that clear.
On the same exact product. So my parents purchased this in the 80s, and they upfront funded it with $100,000. $100,000 that they were told they would one day retire off of, and that it would grow to be worth at least $500,000 by retirement. They were in their early 30s at the time. And so what happened? They put that money in, they moved out of the country, they came back later on, kids grow up a little bit. The time I'm 16 years old, we realized that the premiums, the payments on this policy has started to rise. So they went from no payments, they had paid it all up front and were promised that would be it, to owing payments every single month. At the same
Yep, right there, guys. She's not talking about whole life insurance. This is a universal life product. You know how I know? Because whole life, the premiums stay level, right? And you can actually pay off or pay up a whole life policy and never make another premium payment ever again, and it will continue to grow for the rest of your life. It will still continue to compound. You can do a reduced paid up. You can do a 10 pay, a 20 pay, pay to 65. Heck, you could even do a premium offset where the dividend is used to cover your premium payment. If you like the base premium payment, if you wanted to, like, you have a lot of options there. So that's how I know she's not talking about whole life, which is what you use for infinite banking. So everything she's saying already right off the bat, right in the beginning of the video, has nothing to do with infinite banking, because you are not supposed to use any type of universal life product for infinite banking. And if you do, you're really rolling the dice for very, very little potential additional reward. Okay. And yeah, unfortunately, like in the 80s, with these, because it started off with just traditional universal life, people got destroyed when interest rates started coming down. It's like when interest rates were really high, that's when universal life products were really popular, because that's how the interest was credited to the policies, based on interest rates. And then those interest rates tank. Cost of insurance is still going up because universal life products are built on annual renewable terms. So yeah, and it's so misleading. And she's going to talk about the lawsuit that they had later, which I'm glad they won, because it's so misleading. It's so deceptive. Like you pay it off. She said you put $100,000 in, you never have to make another premium payment again. So on the illustration, you see like there's no premium payments due. So you think in your mind that it's paid off. Like there's no premium payments due anymore. It's just going to grow it's just going to compound at 7-8% for the rest of my life. Yeah, everything's good. And then you reach 70, 80, 90 years old. And I've done videos on these guys, real life, breaking down real life stories of this. You get a bill from the life insurance company saying, hey, you got to pay $10,000 this year or your policy is going to lapse. Like, wait a minute, what? I thought this thing was paid off. What are you talking about? I owe you more money. That's how these products work, guys. Universal life products, not whole life. Whole life is the premiums are level. You could pay. You can actually pay it off, just like you'd pay off a mortgage and still own the home, and the value of the home will continue to increase. You can absolutely do that with a whole life. You cannot pay off a universal life product. The premium will always be there. Now, you can do some fancy design work and all this stuff, lots of different levers you can pull. I mean, if you want to waste your time with that crap, fine. I don't care, as long as you just make sure you know what you're doing. All right, but I want to be clear here. She's not talking about the actual product you use to implement infinite banking. Because she's painting a worst case scenario, and this happens all the time with universal life, unfortunately. All right, but it has nothing to do with infinite banking. All right, let's continue.
Same time, I know this sounds insane, but my dad gets diagnosed with cancer. So we're stuck in this policy. We can't replace it even if we want to. He's uninsurable at the time. And so they start to make payments. You can imagine, not ideal to have to make payments at a time when you are sick and have young kids. And so we continue on with this, and we find out later on.
Yeah, and that's the thing. Now, I don't know, obviously, what kind of policy they set up, but I've already mentioned you can pay off a whole life policy. And there's chronic critical terminal illness riders that like if you get diagnosed with something like cancer, you can actually accelerate a large portion of the death benefit to get the care that you need. The care that maybe your health insurance isn't covering, or, maybe you've maxed out your health insurance, or maybe there's alternative care that they won't pay for or something like that. Like you can accelerate a large portion of the death benefit in your whole life policy. And you could do that with like IULs and other, universal life products, but it's just, again, it's still just way more risk than you need to be taking, in my opinion. But how valuable would that be when you get older, right? That's one of the problems I have with like this buy term and invest the difference crap. Like just, hey, let your life insurance expire, after 20, 30 years. You're not going to need it because you can be self-insured. Well, what happens when you get diagnosed with cancer? What's going to happen then? So your retirement portfolio that you're using for income and all this other stuff is now all of a sudden going to be the lifeboat that you rely on. Getting sick, getting diagnosed with cancer bankrupts people, guys. These devastating medical events, they bankrupt people. Like it costs hundreds of thousands of dollars. I know somebody, actually had him on my channel. I believe it was his grandmother, went through $1 million of her retirement for long-term care, right? Imagine if she had a policy, not just a whole life, but maybe an asset care whole life product where, it's specifically for long-term care. You see what I'm saying? Like that, these can be really beneficial when stuff like that happens. And again, it's just, she's not talking about.
It becomes my career later on. My sister gets licensed as well. We go to visit my parents. We dig into this policy and we actually end up suing that insurer in a class action lawsuit. My parents win. They're awarded $6,000 in that class action lawsuit. And they were able to take out their cash value, which is the balance that had grown over all those years from the 80s to now we're talking about deep into the 2000s. So in that time period, they put $100,000 in, they get a $6,000 lawsuit benefit, and they cash out that policy for $70,000. So they walk away with.
That's crazy, man. Again, that's how I know it's not. Another reason I know it's not whole life. I'm glad they sued and I'm glad they won. They absolutely should. Because, man, some of the marketing practices from these companies, man, you got to be so careful. Like even some mutually owned life insurance companies out there, like, I'm a huge fan of mutually owned companies, with dividend paying whole life, because we partner up with some of the strongest the most financially sound companies in the world. It gives us a really strong foundation. But there are companies out there with just really extremely deceptive marketing practices, like showing just uninterrupted growth. And like what they often illustrate is the best case scenario. But guys, how often have you known when life turns out best case scenario? It doesn't. We need to prepare for the worst case scenario, hope for the best case scenario, mitigate our risk as much as possible. A lot of that has to do with education and knowledge and knowing what we're looking at, knowing what we're putting our money into. All right, but you got to be really careful. You got to know what you're committing to here. And obviously they didn't. I'm not putting it on them. All right. There's a little bit of accountability on the end of the consumer to do their research. But at the end of the day, it's really these life insurance companies and these professionals and stuff like that, like, that I think have a duty, a responsibility to make sure that they are marketing these things in a much more conservative way, a much more realistic way, and stop painting the best case scenario. Because when that doesn't happen, when that best case scenario doesn't happen, everything blows up in their face. So like she's talking about how they bought this in the 80s, which was that I'm pretty sure that would be a traditional universal life product. All right. And now we're far into the 2000s. Heck, a whole life policy should have a custom design high cash value policy will long break even and have way more cash value in it than what you've put in by that time. My first policy, guys, is set to break even by the end, or very close, by the end of year 3, meaning I will have access to, in cash value, to as much as I've put into the policy. From there, I'm going to have, like every year beyond that, I'm going to have more cash value than what I put into the policy. And if I were to surrender that, if I were to like be in this scenario where for example, and I would surrender it, I would actually create a taxable event because I would get more than what I put into the policy. Their situation is the exact opposite. And after they sued him, they still didn't get all their money back. They got a $6,000 lawsuit award, whatever, and then they cash it out for $70,000. They put 100 in, they only got out 70. That means the policy was eating itself alive. A whole life policy doesn't do that. A whole life policy, especially when designed for high cash value, is, well, even when it's not designed for high cash value, it's guaranteed to grow every single year. These policies have guarantees. The only thing guaranteed about a universal life product is that it's not going to do what you're looking at in the illustration. Okay, I mean, I'm exaggerating. There's maybe some guarantees with some types of universal life products out there. Okay, but you get my point. You see my point here. Like, she's not talking about whole life; it's universal life, and I share her frustration about that. But that doesn't mean infinite banking is bad. It doesn't mean whole life is bad. It's really powerful when you do it right. But guys, you do have to be very careful. Don't fall for the hype. Hear both sides of the story, get the facts, get the information, right? Analyze your situation, see if it's good for you, then pull the trigger if it makes sense.
$76,000 over 20 years later from this policy. Well, you might say, well, at least they got some money back while they were insured. I get nothing back if I buy term. Let me tell you the real numbers, because thanks to my career, I've been able to do this and to actually analyze it and run historical performance. If they had bought term and invested the difference in the 80s when they bought this policy, and they had continued to pay for that life insurance out of pocket and left the rest invested in an average fund, literally just an average growth and income fund, it calculated to be about $3.4 million that they would have gotten back in their 60s instead of the $70,000 and the $6,000 that they got through the lawsuit.
That's painful. Now, are those, how do we come up with those numbers? Are we using an average rate of return, which that in and of itself is pretty misleading? Like, just because you get an average rate of return of 10%, that doesn't mean, like, if you plug that into a calculator, like if I start with 100,000 and the market has done 30% or has done an average of 10% over the last 30 years. Okay, well, if I put $100,000 into a compound interest calculator at 10%, and here's my ending balance, that's not what's going to happen, guys. So I don't know how she came up with those numbers. If she's using average rate of return, it's that in and of itself is pretty misleading. So be careful with that. With that said, would they have been better than doing what they did if they had bought term and invested difference? Absolutely. Because universal life, in my opinion, is just a fundamentally flawed product. It's very risky. It's very dangerous. You better make sure you know what you're doing. Better make sure you know how to maintain the policy and how to design it and all this other crap. I mean, you got to design a whole life policy too, but it's much simpler. But where's I going with that? The ending balance for that. Like, I'm still not a huge fan of buy term and invest the difference, because that assumes that you're going to be self-insured by the time you're 65, 70 years old. And a lot of times, just look at the average numbers, guys. Like, the average 401k balance, for example, between, I think it's like 55 to 64, something like that. It's like $250,000. Like, it's nothing. How are you going to make that last for 20, 30 years? And then how are you going to use that to cover medical expenses when you get cancer, or if you get diagnosed with cancer or whatever other, disease, right? So that's supposed to be your lifeboat and your income and the legacy play and, XYZ, not to mention you have to time the market too, to make because you don't want to sell assets in your 401k or tax qualified plan or market investments when the market's down, because now you're accelerating the depreciation. You're accelerating. I don't know what, I lost my train of thought there. What word I'm looking for, but you are accelerating the depletion. That's what I was looking for. Depletion of your market assets when you sell during a down market. So you have to time the market as well. Like, I mean, maybe if you're good at that, fine. But this idea of being self-insured and you don't need life insurance when you're in retirement is just absolutely ridiculous. Especially since you can pay off a whole life policy and never make another premium payment ever again. You don't have to pay for it in retirement. You can have it paid off. And now you just have this asset that grows for the rest of your life that you can access as a volatility buffer. So you can still have your market assets, guys. I do infinite banking with whole life insurance and I have market assets. Why can't we do both? I don't understand this idea of it's either or. No, it's not. You can do both. And whole life, it can serve as an amazing volatility buffer so that you can spend down your market assets much more efficiently if you want. You can spend more of it if you want, because when the market's down, you could tap into this asset that has nothing to do with market volatility. In fact, it's guaranteed to grow every single year. So, maybe during a year where the market's down 20%, well, instead of selling into that downturn, what if for my income that year, What if I take my income from my volatility buffer, my whole life policy? I can make a withdrawal. I can turn my dividend into cash. I can do a policy loan. It's all tax-free, depending on how you do it. And if you can withdraw up to your basis tax-free, anything beyond that will be taxed. That's why we usually don't recommend withdrawals. Same thing with the dividend, right? You can take that up to your basis. Policy loans, though, because it's debt, those are tax-free. It's not a taxable event, right? So I use it as a volatility buffer. Heck, it's a pension maximization asset as well. Like if you have pensions or you're going to do annuities or guess just rely on the market, like you can spend more of your assets, not worry about like how your spouse is going to be taken care of or your kids or anything like that. Like if you're thinking about a legacy play, because you know that there's going to be this massive income tax-free check that your spouse or your like whoever your beneficiary is, they're going to get. So that means, I can have more fun with my assets over here because my loved ones are going to be made whole after I pass. I don't have to necessarily worry about them after I pass because I have this income tax-free death benefit. So pension maximization, right? Obviously, it's a fantastic legacy play, right? So a lot of benefits to having whole life insurance, permanent whole life insurance in retirement. So this is buy term and invest the difference thing. I'm not a huge fan of it. So anyways, we'll continue.
3.5 million. Ask yourself today, if it's you, if it's your family, if it's the people around you, which one would you choose? And so I want to break down for you because I know the choice, right? I know the regret that my parents, smart, hardworking people, immigrants, like most of the people that these products are sold to, they didn't have the same access. They didn't have the same financial literacy in North America at the time. I want you to know how these actually work. All right, so let's go ahead and debunk it piece by piece on all the stuff that they use really as attraction mechanisms for new clients. So the first thing they're going to tell you is that the Rockefellers did this. This is how they created wealth. And I want to tell you quite simply that you can't be your own bank or create wealth if you don't already have some money. So the Rockefellers.
I actually agree with this for the most part. That's a great point. Infinite banking is, for me, it's a wealth acceleration strategy, but it's not going to necessarily make you rich if you can't put capital into it, if you can't fund it, if you're not able to save money on a regular basis, if you're not able to fund your private banking system, then it's not really going to do too much for you. That's not to say that you need tons of money in order to do it, but I'm saying we need some realistic expectations here. Like if you're only able to put $300, $400, $500 a month into it, like you can't front load it, so you don't have any cash saved. Like maybe 10. I recommend a minimum of 10,000 like your first year, and then maybe 2,000 or 3,000 per year after that. Whatever. That's a design topic. All right, but like if you're only able to put a couple $100 a month into it, like infinite banking isn't going to magically, whole life insurance or any of these products, but they're not going to magically make you rich. Okay, and what she's going to talk about here in a minute is the way to get. Well, gotta be careful with this, how I say it, or position it. Like not necessarily to get rich, but how you make money. Like starting a business. Are you doing real estate? Are you doing really good at your job? Are you CEO or like some type of executive position or something like that? Providing value to the world in some way, shape, or form. That's what attracts the money to you, right? The more value you provide to the marketplace, the more money you tend to make. And then I can deploy that capital in different ways to accelerate the wealth building process, as opposed to just working for money my entire life. I can now deploy that money in different assets and implement different strategies to build wealth for me much faster. Okay. So I actually agree with that. Infinite bank is not going to make you rich. It will accelerate or can accelerate the wealth building process, but you need to be you need to have income, like preferably multiple streams of income coming in, so that we have money and capital to deploy at that point. So I actually very strongly agree with that for the most part.
Rockefellers did not become rich by using life insurance. They had businesses and they invested in appreciating assets. Most importantly, those assets went into a trust, and that's what protected it and made it continue to grow and sustain the next generation.
Yes, absolutely. I'm glad she brought up the trust part, because Rockefellers, yeah, I mean, they gotta look up the book, read the book Rockefeller Method by Garrett Gunderson, guys. It is a fascinating book. But the Rockefellers do use permanent life insurance. Typically, it's whole life, all right, permanent whole life insurance policies to build generational wealth. And a lot of times, like basically, kind of the 30,000 foot overview is they have these these massive amounts of death benefit that gets paid into the trust, the family trust. Okay. And then those proceeds are used to purchase more life insurance, more permanent whole life insurance on the next generation. Now, it's more nuanced than that. Like, it's much more sophisticated, but that's, again, it's a 30,000 foot overview, and it's a very effective way to build generational wealth. But I agree. Like, they had businesses, they had real estate, they had assets that they move into the trust as well. But one of those assets is permanent whole life insurance, because it's a phenomenal way to build generational wealth. So really, really important point there.
These policies are going to tell you that you can pay now and be covered forever. Not the case. That's based on estimates and hypotheticals, and at any point, you could end up owing money again. They're going to tell you that it's going to...
Not with whole life insurance, guys. If you pay off a whole life policy, you're never going to get another bill from the life insurance company ever again. If you buy what she's talking about, any type of universal life product, that absolutely can happen. I'm not saying it will happen, but a lot of the times it does. When you don't know what you're doing, you don't work with the right people, you don't design it right, you don't understand the product. Yes, 110%, which is why just stay away from it 9 times out of 10. Anyways.
Grow tax-free. Not true. It is tax-deferred growth. If you have ever put money into a policy and taken it out and not owed tax, there's a simple reason. You had no actual profit. Okay, you had...
All right. So technically, she's right about the tax deferred. All right, in the IRS code or whatever. Yes, life insurance, like the cash value in life insurance, grows tax deferred, but you can access it tax free via policy loans, or you could withdraw up to your basis, right? Because it's taxed first in, first out. So if you make a withdrawal, you're basically taking out your own money that you put in. That's how the IRS sees it, anyways. But you can take a policy loan, and because it's not a taxable event, it's tax-free. Now you have to manage that, right? That's a different video. All right, but technically she's right about it's technically gross tax deferred, but you can access it tax-free.
No gain. So they did an adjusted cost basis, what you put in, what it costs you to keep that policy. You take it out. If there's zero profit, then you're right. It is tax-free. They're going to tell you you can leave your money in and borrow on your own money. Well, that part is true, but what they don't tell you is you have to pay interest. And typically in a whole life policy, that interest, 6 to 8% per year. And it's...
See, now all of a sudden she mentions whole life, but she hasn't been talking about whole life the entire time. So let's address the interest part of it. Yeah, that's true. And anybody that doesn't disclose that to you about these products, be careful. There is an interest cost. Like, anytime I take a policy loan and I invest it in real estate or whatever, I'm going to pay interest to the life insurance company, not myself. Like this idea that you're going to pay yourself interest. The only thing that does is it pays off the policy loan faster, but that interest that you're paying yourself doesn't go to you. Like, there is an interest cost that gets paid to the life insurance company. Is that a bad thing? It can be if you don't know what you're doing. If you just borrow money because you think you might get positive arbitrage, that's another big talking point with a lot of influencers out there. Well, that's just dumb. You don't want to be doing that, in my opinion anyways. It comes down to how you're going to use the policy to build wealth, right? It's not like, oh, I'm just going to borrow money and I'm earning 4%, but maybe or I'm earning 5 or 6%. Maybe I'll only pay 5. Like, no, it doesn't work like that. Every company is a little bit different with the interest rate they charge. Right now, it ranges, I think, between like 5.5% and 7%, give or take. And these policies are netting. They typically net like 4 to maybe 5%, depending on a few factors, right? So that sounds bad, right? Like, why would I pay 5.5? Let's call it 6. Let's call it 6% if I'm only earning 4. Okay, well, a couple of reasons. Number one, there's a huge difference between earning compound interest and paying simple interest, which is what you pay on a policy loan. I've done videos on that. If you want a full breakdown on the numbers on that, drop a comment down below. I will send you that video. I've run the numbers on this, guys, where you could technically only earn 4%, but if it's compounding, you could pay 6% on simple interest and still come out ahead in the long run. Now, that doesn't mean we don't that doesn't mean we just put ourselves in our situation because of that. All right. The next part is, what are we using the money for? This is where the private banking system starts to come into play when it comes to building wealth, that is, where I'm going to borrow at 6%, but I'm going to lend it out at 13% plus a point. That's exactly what I do in my own private banking system. I borrow at 6. I lend it to my real estate investor to do his fix and flip deal or whatever at 13% plus a point, and I create a spread there. But get this, the kicker is my policy, the cash value of my policy is still compounding because I'm using the life insurance company's money. I'm not borrowing my own money, guys. Okay, you're borrowing the life insurance company's money, so there's going to be an interest cost, right? But because of that, my money continues to compound uninterrupted. So I'm earning money twice. I'm earning money in the policy, cash value is continuing to grow, and I'm keeping the spread on the deal that I just did. So now does it make sense to borrow at 6 if I'm only earning 4 in the policy? Well, absolutely, because this is exactly what banks do. They pay us 1% in our savings account, but then they lend it back to us at 4, 5, 6% for the car loan, the mortgage, or whatever. How's it any different than what I'm doing with my policies in real estate? Okay, so with that said, you have to be careful, right? This is not just an automatic way to build wealth. You have to, there's risk involved, especially like when I'm doing real estate, right? But there's ways to mitigate that. Okay. But just because you might pay, you're going to pay a higher interest rate and earn a lower interest rate, that doesn't automatically mean it's bad. I want to be very clear on that. It comes down to how are you using the policy loan, right? Very important.
Not paid to you like in a 401k loan, it is absolutely paid to that company. In a product that if you look up historical returns, if you're talking about whole life insurance, it's like checking or savings accounts combined with life insurance. That whole life product probably returned between a 2 and 4% interest rate, but they can borrow you 6, 8, sometimes 10%. Sorry, they can charge you 6.
Yeah. So I'm glad she made the right comparison there, comparing whole life to checking, savings, bonds, because a lot of times people compare whole life to stock market investments. It just doesn't make any sense. Now she will get into buy term and invest the difference and stuff, but you could do both if you wanted to. But again, just to reiterate, like just because you're paying a higher interest rate, earning lower, the difference in compound and simple interest combined with what you're using the policy loan for, that's a very big factor in this process here.
6, 8, 10% to borrow your own money. So that's a loss, guys. There's really no way to do.
It's not 10%. I think legally the highest a mutually owned life insurance company can charge for a policy loan, I think, is 8%. So 8 to 10%. No.
Do that math and make it anything but a loss. What else? What else do they have? They're gonna say, well, you're covered till you're 100 years old. And so I need this because what if I die when I'm 100? Hey, my grandma lived to 99. God bless her. I hope I match her health and longevity. But at 99 years old, none of her kids or grandkids or her 12 great grandkids were waiting for Yaya to leave us her wealth. Instead, she had prepaid her final expenses and no one needed anything from her and she didn't need anything from us. When you need life insurance is when you have dependents, people that need something from you. You have young kids, you have anybody who needs your income and you're still actively working for that income, you need life insurance. So
I disagree. And here's why. Let's talk about the legacy aspect here really quick. Let's address that. I mean, what if somebody does want to leave a powerful legacy? I mean, I guess her argument would be, oh, well, she'll leave all the other assets that she has. Okay, but whole life, like permanent whole life insurance, it completely skips probate, income tax-free death benefit. You can put it into a trust to start building generational wealth. There's power in that, man. It allows you to continue to create and provide value to the world long after you're gone. I think that's really cool. But also, like, oh, you don't need life insurance because you only need it when you have dependents. Well, no, I have lots of life insurance and I don't have any kids. I'm not even married. I use it as a wealth building tool because it just has so many benefits. I'm not going to go into all of them again. I already alluded to it, but in retirement, it's a really powerful retirement asset because, like I mentioned, the volatility buffer, pension maximization, the legacy play, income tax-free death benefit, long-term care benefits. When inevitably we do get sick, I mean, it just happens when we get older, we can accelerate a large portion of that death benefit, gives us a lot of options, a lot of control over our medical directive. I think there's value in that. All right. So it's not just about dependence. Not to mention, I mean, it's just a really powerful wealth building tool when you use it right.
What should you do instead? Use those dollars, and instead of having 100,000 till you're 100, you should get $1 million or more when you're young, and you have those dependents, and everything else should go into the stock market.
Okay, well, I'm not saying like she intentionally left this out, but again, she's just not talking about the right type of policy that's used for infinite banking. And notice she hasn't really said anything about infinite banking itself. But with whole life, your death benefit increases. You wouldn't have the same $100,000 death benefit when you pass away. Like if you bought it in your 30s and you live to 99, you're not going to have only $100,000 of death benefit. Your death benefit grows with the cash value grows, death benefit grows, right? As like every year, right? Because that's just how whole life works. Like when you're using your dividends for paid up additions and stuff like that, your policy continues to grow. The death benefit does as well. So you'll have, like, by the time I'm in my 80s, I'm gonna have a lot of death benefit, and I won't be making premium payments anymore. Pretty cool.
Couple points. We've got new variations on these products coming out all the time. We had whole life, then we had universal life, indexed universal life, return to premium, all fundamentally the same. Life insurance and a savings component wrapped into one. Because they're wrapped into...
Oh my goodness, no. Not even close to the same thing. Are you kidding me? Like, whole life is in a completely different ballpark as far as I'm concerned compared to any of these universal life products. Like, the way that the policies grow, oh man. And also, here's I'm just going to mention this really quick, guys. One of the main differences too between whole life and these universal life products is that with whole life, really the only thing that can change is the dividend rate and whether or not the company will continue to pay a dividend, right? With these universal life products, they could change a lot of stuff to manage their risk, usually at the detriment to the policy holder. So, like, especially with IULs, like cap rates, par rates, spread charges, no risk rates, cost of insurance, which a lot of them, don't increase the actual cost of insurance, but your cost of insurance increases every single year because it's built on annual renewable term, right? There's a lot that you don't have control over inside of these universal life products, which is why they're not good for infinite banking. Like, how do you build a predictable, consistent private banking system when the foundation of that system can be changed by a third party? That doesn't make any sense to me. So when she says, like, whole life, universal life, they're all the same. Life insurance wrapped with savings. No, they're very, very different products, guys.
To one, the insurance companies can charge you life insurance fees, morbidity, mortality fees, policy fees on the investment component as well. Because of that, and because of the limited options.
In a universal life product, sure. Typically, that's going to be variable universal life VULs.
It's never going to be better than a pure investment. And when you get into the most recent product,
that I agree with. Like, that's why I don't really see a point of VULs. If you guys are using those successfully out there, drop a comment down below and explain that to me. But yeah, I think I don't know why you would combine life insurance with investments. Like, you're probably better off just buying the pure investment because, like, VULs, the fees, oh my God, they can be, like, outrageous.
The indexed universal life, they're going to sell to younger clients, people in their 20s and 30s, and they're going to tell you that you can get all your money back, and as a bonus, you get life insurance. You need to read that policy and see something called cap rates. What are cap rates? It means if you're in the S&P, it should invest like the index, but your cap rate is 8. If the S&P does 24 or 26%, like these great years we've seen, you never make more than 8. That cap is your limit on profit. So bottom line, guys, these policies and the people selling them and creating these videos, they promise a whole lot. They don't deliver on most of that. Your best...
I can't argue with that. It's just sitting here talking about IULs and stuff. And heck, look at the recent lawsuit with Kyle Busch, $8.5 million loss in IUL. A lot of the times these things don't live up to the hype, and the potential additional minor amount of reward in these IULs that you might get over a whole life policy over 30 years, it's just not worth the risk, man. And those cap rates are changed all the time. They start marketing them at, they start at 12, 11 or 12% or whatever. And then, 4 or 5 years into it, you're at 8 or 9%. Like, what does that do to the long-term performance of your policy, guys? And that's what I'm talking about when I'm mentioning the control, the consistency, the predictability of the foundation that you set for your private banking system to use to implement infinite banking. With whole life, we don't have to worry about any of that. The only question is a company that has paid dividends for 150 years through the Great Depression, Great Recession, the pandemic, both world wars, are they going to continue paying dividends? And what's the dividend rate going to be? That's it. That's all you have to ask yourself. I don't have to worry about what the market's doing. I don't have to worry about cap rates. None of this crap. I just, So we're in alignment with that.
Option will always be to buy a true, pure, high-quality investment. Get it tax-deferred if you can through a Roth, through a 401k. Talk to a specialist on that. Tax shelter, protect it, get it invested. Beat inflation, weather those fluctuations, build some real wealth for yourself while you're doing it. Protect the in-between while you're building your wealth with a simple, high-quality, low-cost term life insurance policy.
So, all right, we'll wrap up there. I'm not against term. I have term in my whole life policies. We typically add a term policy to whole life to avoid it becoming what's called a modified endowment contract or a MEC. So you can add term to your whole life policies, guys. Again, it's not an either or. All right. And what else? I don't have a problem with like investment. I make my own investments. Oh, she mentioned inflation, like beat inflation. Well, guys, the stock market's not the only way to beat inflation. I'm smoking inflation with infinite banking. It's absolutely smoking it. How could I not? If I'm earning money twice, if I'm building wealth in multiple layers at once, how could I not absolutely crush inflation? So I'm not even talking about just like my policy growth. Like my policy growth, I'm keeping up with inflation, or pretty close anyways, especially since they're outperforming. All right, so I've got my base, my foundation that's going to compound for the rest of my life, major tax advantages, right? But then I'm creating a spread when I borrow against that policy, lend it out on real estate. I'm making a 7-8 point spread. Crushing inflation, guys. Absolutely smoking it. And to me, it's actually less risk than the stock market because I have so much more, ready for it, control over the process, over that specific investment. Now, I'm not saying everybody needs to be a real estate lender. You don't have to do that, okay? But figure out what your investor DNA is. Figure out what do you know, like, and understand. Right? That's usually a really good formula, a really good way of discovering like where to deploy capital and make investments and stuff. But anyways, I hope that was helpful. I love doing these reaction videos. It's a lot of fun. I like seeing what's out there and hearing other people's thoughts. What I don't like is misleading content, is what it is. But hopefully that helps. If you guys are interested in infinite banking and you want to learn more, I have a free infinite banking masterclass down below in the description. Take advantage of that. It's about an hour long. I have an infinite banking book coming out, like just my own personal experience with it. I'll have that down below when it's ready. And check out all my other videos, guys. I've done so many videos just sharing how I am implementing infinite banking and how I'm benefiting from it. And if that resonates with you, book a call, let's have a conversation, see if it's right for you. Certainly not right for everybody, but how do you know unless you do the research? Do the research, guys. So hope you guys are crushing it. I will talk to you in the next one. To your success. Matty Ice is out.